Debt, most people view debt as a negative aspect of finance, something to be avoided. However, what if I told you that not all debt is created equal? Yes, there's good debt and there's bad debt. The difference between the two can be a game changer in your financial life. Today, we're going to break down this complex subject and look at 6 specific ways that wealthy individuals use debt as a tool to increase their wealth. Whether you're new to the world of finance or you're someone who's looking to optimize your financial strategies, this video will provide you with valuable insights. So let's get started. In the financial world, debt is often seen as a double-edged sword. On one side, it can be a burden that drags you down. On the other, it can be a resource that helps you build wealth. The key is to understand the 2 main categories of debt: good debt and bad debt. Good debt is essentially an investment that will generate income or increase in value over time. Think of student loans that enable you to get a higher-paying job or a mortgage for a home that appreciates in value. Bad debt, on the other hand, is debt that you take on for things that lose value and do not generate income. Examples include credit card debt from shopping sprees or high-interest loans for depreciating assets like cars. Knowing the difference between these 2 types of debt is crucial for anyone looking to improve their financial situation. One of the most common ways wealthy individuals use debt to their advantage is through real estate investments. The term leverage is often associated with this strategy. In simple terms, leverage in real estate means using borrowed capital for an investment and expecting the profits made to be higher than the interest payable. For instance, if you buy a property worth $200,000 with a down payment of $40,000 and a loan for the remaining $160,000, you're using leverage. The goal is for the property to appreciate in value or generate rental income that exceeds the cost of the mortgage and other expenses. This allows you to not only pay off the debt, but also to make a profit. It's a strategy that has been used effectively by many wealthy investors to grow their portfolios and increase their net worth. However, it's essential to understand the risks involved, such as market downturns or interest rate hikes, and to manage them carefully to ensure a successful investment. Another financial strategy that wealthy individuals often employ is the leveraged buyout, commonly abbreviated as LBO. In a leveraged buyout, an individual or a company acquires another business, primarily using borrowed funds. These funds usually come from loans or bonds, and the acquired company's assets often serve as collateral. The objective is to improve the acquired company's performance to the point where it can not only repay the loan, but also provide a healthy return on investment. For example, if a wealthy investor acquires a struggling company for $10 million, using $2 million of their own money and borrowing the remaining $8 million, they are engaging in a leveraged buyout. The goal is to turn the company around, make it profitable, and perhaps even sell it later for a higher price. While this strategy can be highly rewarding, it's not without risks, such as the acquired company failing to perform as expected. Therefore, it's crucial to conduct thorough due diligence before undertaking such a financial move. Short selling is another method by which wealthy individuals can profit. It's complex and carries its own set of risks. It involves borrowing shares of a stock from a broker and selling them immediately at the current price. The goal is to buy back the shares at a lower price in the future, return them to the broker, and pocket the difference. For example, if an investor shorts 100 shares of a company at $50 per share and the price drops to $40, they can buy back the shares for $4,000, return them, and make a $1,000 profit. It's a strategy that requires a deep understanding of market trends and a keen eye for detail. While it can be profitable, the risks are high. If the stock price increases instead of falling, the losses can be significant. Therefore, it's a strategy best suited for those who are well-versed in market analysis and risk assessment. When it comes to building wealth, savvy investors often use debt strategically. Unlike ordinary loans used for consumption, these types of debt are designed to generate income or increase net worth over time. For instance, taking out a business loan to expand operations can lead to increased revenue, effectively making the loan a worthwhile investment. Similarly, borrowing to invest in dividend-paying stocks or bonds can also yield returns that outweigh the interest payments. According to a NASDAQ article, wealthy individuals often use debt to acquire companies, fund startups, or invest in assets that will increase their wealth over time. Consider the example of entrepreneurs in the tech industry. Many have been known to take on debt to acquire smaller startups that they can integrate into their existing businesses. The key here is to ensure that the investment provides a return that is higher than the cost of borrowing. This is a common practice among wealthy individuals who have a clear understanding of both the risks and potential rewards. It's essential to have a well-thought-out plan and to be aware of market conditions to make the most of this strategy. Credit cards are often viewed as a quick route to accumulating bad debt, but when used wisely, they can actually be a financial asset. Wealthy individuals use credit cards in a way that benefits them, specifically by taking advantage of rewards programs and paying off the balance in full each month to avoid interest charges. They use credit cards to collect rewards rather than paying interest. They are strategic about which cards they use and for what purpose, ensuring they maximize benefits like cashback, miles, or points. Wealthy individuals often use premium credit cards that offer substantial rewards and benefits like flight upgrades and concierge services. While we've discussed how debt can be a tool for building wealth, it's equally important to recognize when debt can be detrimental. One such instance is accumulating debt for depreciating assets. These are items that lose value over time, such as cars or electronics. Wealthy individuals typically avoid financing depreciating assets, preferring instead to invest in assets that maintain or increase in value. Rather than obtaining a loan for a new car, which quickly loses value, a prosperous person might opt for a luxury car lease. This strategy sidesteps the immediate depreciation hitting new vehicle purchases, showcasing their financial savvy. By doing so, they preserve their wealth and optimize their financial health, demonstrating a keen understanding of asset management and the importance of making strategic financial decisions that align with long-term wealth preservation and growth objectives. Wealthy individuals are strategic about managing their debts, actively seeking the best loan terms to enhance their financial standing. They leverage their business savvy and financial resources to make lenders vie for their patronage, often resulting in more favorable interest rates and repayment conditions. These high-net-worth individuals do their homework, shopping around and negotiating with various lenders to optimize their loan conditions. Take, for example, a prosperous real estate investor looking to finance a major property acquisition. Rather than settling for the initial loan offer, they engage with several lenders, negotiating to attain a reduced interest rate. This approach not only demonstrates their financial acumen, but also underscores the importance of proactive debt management. By doing so, they ensure substantial savings throughout the loan's duration, showcasing a savvy utilization of the lending market to their advantage. From leveraging real estate and executing leveraged buyouts to making credit cards pay you, the key is to use debt wisely and strategically. We've also emphasized the importance of financial literacy and risk management. Understanding the difference between good and bad debt and knowing how to manage risks can make a significant difference in your financial outcomes. If you found this video informative and valuable, please give it a thumbs up, share it with others who might benefit, and don't forget to subscribe to our channel for more content like this.